Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Seems the Asian equities are set to follow US equities, which seem to be still celebrating Christmas. Equities are near the highs, dollar continues to remain weaker, and things even now don't seem as bad or recessionary except for the disruption in commerce in the Red Sea. Morning, JK, not much of fresh triggers. Your thoughts on markets right now?
Good morning, Swaraj. So on the global markets, liquidity is definitely at a premium, and the reports show that lowest volume in bond market for the year was seen yesterday. And no surprise then that yields have also moved in a very narrow range. But importantly, the lows are still holding. Even in thin market, of course, there was no stopping the equity market, which made another stride higher with the latest boost to bulls coming from the PC inflation that dropped last week. US prices actually fell for the first time on a month-on-month basis since 2020. And all the three indices in US were on track for a monthly, quarterly, and annual gains. And of course, Dow Jones made a new all-time high, and S&P is just under 1% from the all-time high. So it's the bull market that doesn't seem to end, and valuations have not been a threat, and the valuation concerns remain only in the analyst domain. Markets in Australia, UK, New Zealand, Hong Kong, and many others were still out for a public holiday, so there was not much action on the other markets as well. But the dollar is trading still at the lower end of its monthly range, for many months, and not many buyers for dollars. Although I think the volume, or rather the absence of big players, would make a difference. And perhaps when they come back, you see some recovery in the dollar, because the news from US has not been all that bad. Most of the data have been, on the positive side, and inflation has been coming down, and asset markets in US are doing well. So as we enter into a new year, perhaps we will see the fresh demand for US assets, particularly in the on the treasuries, etc., which will keep the dollar a bit. And of course, at around the same time, last year, markets were betting that Fed would raise rates by some 50 basis points by the middle of 2023 and look forward to unwind some of its tightening by the end of 2023. As it happened, Fed had to raise rates by twice as much, and there's obviously no scope for loosening the policy as well. Now the interest rate traders are factoring in a plenty of policy loosening based on conviction that inflation is on the rear view mirror, and even as the US economy, especially the labor market, seems to be broadly resilient. Fed estimates it can loosen by 0.75% in 2024, but the markets reckon twice as much. And given the strength of the labor market, it is hard to say with great conviction that the inflation will slow to 2% anytime soon, which may upend the market's actual calculation. Which is why I feel 2024 might have a curveball in store for forecasters, much like 2023 did. But then we will wait for another 2 weeks to know if that is the case. Then looking at rupee, the positive cues like weak dollar index, risk assets continued rally, all these did the rupee yesterday, which continued to hover near 83.20 with demand persisting. And there's little by way of global data to move the market, either way as well, except possibly the year-end flows. And we have not so far seen any sustainable reaction of the rupee to either positive or negative global cues also. We expect market respecting the recent range and moving independently, mostly looking up to the central bank approach, which has been unusually one of tight hold on exchange rate. Okay, we did have India's macro data of current account and BOP also yesterday. Current account showing a drop to 8.3 billion from 9.2 billion in Q1. So 8.3 billion or 1% was for Q2, that is the July-September quarter. And it was much higher, of course, at 30.9%. 30.9 billion or 3.8% of GDP last year for a similar period. The drop in the latest number is due to fall in trade deficit and higher remittances by non-resident Indians, which rose by 2.6%. But I should mention that we have to be aware of this number being 3-month-old, in the sense it's for the period from July to September, and we are already in December. So the trade numbers do get volatile. There are fluctuations month on month basis, and there are accumulated trade payments which affect the trade numbers, all these things. So rather than looking at one number, we should always look at trend in the current account, and trend in the current account largely in India has been on the negative side. Only the percentage varies. We are always between 1 on the lower side and around 3 on the higher side. We are somewhere in the middle right now. So it's a manageable number because we continue to get capital flows. It's only when the capital flows stop that we have a problem on our hand to fund the current account, and it reflects in the exchange rate as well. And relatedly, we did have balance of payments also recording a surplus of 2.5 million in September quarter. Of course, last year for a similar period, we had 30.4 billion. This surplus, however, narrowed sharply on a quarter-on-quarter basis. So for April, June, we had 24.4 billion surplus. So that's again another volatile number. But I think we have been seeing a lot of capital outflows which are reflected in the lower surplus, and it's very critical that in the coming quarters for Q3 as well as Q4 we have good capital flows, and there is a lot of promise of that because we are going to have the bond related inflows, and perhaps the FDI is also starting as and when the investors get confident about the new stable government at the center. So it does not look bad as far as the external macros for India is concerned, though they remain a bit volatile. So on the rupee front, this will not have an immediate impact. And as and when we see signs of BOP rising more, I think that's when, in other words, higher inflows. That is when probably the central bank gets more confident about the rupee reflecting its true value. Thank you.
Thank you, JK. And of course, just quickly summarizing, global market liquidity has been thin. Equities continue to make move higher. Dow Jones made a new fresh all-time high. The dollar continued to trade lower end of its range as traders price interest rate cuts starting next year and as early as March. For rupee, positive global factors and flows did not impact much. It continued to trade near 83.20. While we had some Indian macro data yesterday, India's current account deficit showed a drop for the second quarter versus the first quarter. It came at 8.3 billion for the second quarter versus 9.1 for the first quarter. Uh, Now, the drop is due to a low trade deficit and higher flows in terms of remittances. But as JK mentioned, the data is quite old and we need to see the coming 3 months data. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.